Welcome, everyone. Today we have Joe Bazoyan, Portfolio Manager of Global Credit, to share with us the outlook of preferred securities. Joe, do you think preferred securities can weather the high inflation environment?
Yeah, although inflation fears raised the volatility in financial markets recently, preferred securities have outperformed other asset classes during past inflationary periods, with the exception of U.S. high-yield bonds. It's worth remembering that on average, the average credit rating of U.S. high-yield bonds is single B minus, whereas preferreds are triple B, which is investment grade. In addition, when investing in U.S. high-yield bonds, investors are exposed to greater credit risks than preferreds. In the current inflation cycle, the U.S. Federal Reserve is aggressively hiking interest rates in an attempt to contain inflation. As we have been positioning for rate hikes, we believe our strategy should perform well against this backdrop.
How would you change your investment strategy across different market cycles?
There are various types of preferred securities that can provide us with greater investment flexibility to generate potential excess returns depending on the economic conditions. For example, in a period when both Fed funds rates and inflation are rising, we would buy more junior subordinated notes because many of them are fixed to floating rate securities. These would help protect against a rapid rise in rates. In a period of slowing U.S. growth or recession, we would increase our exposure to baby bonds. These are higher up in the capital structure relative to preferreds, which should provide some protection against spread widening amid an economic slowdown. Alongside that, we would increase the overall credit quality in this environment as well, essentially buying credit quality on sale. In a scenario where both Fed fund rates and inflation are falling, we would want to increase duration by buying fixed-for-life preferred securities.
Looking ahead to 2023, what are the investment themes for preferred securities?
Sure. The biggest theme for preferreds this year is quality. We are most likely headed for an economic slowdown or a mild recession. The Fed's goal is to bring down inflation, and it can only do this by slowing the economy. As such, we have to be very careful to avoid buying securities that are susceptible to spread widening. We would also expect defaults to increase in the high-yield market. This is why we have been taking the steps to increase credit quality in our strategy, and we will continue to have that as a theme for us in 2023. Another theme is to continue to overweight the utility sector. We believe that we will see many sectors of the S&P 500 struggle in 2023, with earnings likely to come down. Utilities will show their resilience once again by maintaining their allowable earnings growth of between 5 and 7%, which we believe will outpace many other sectors. The other thing to start thinking about is increasing duration. The Fed will slow down and eventually pause rate hikes into 2023. Preferreds tend to perform well when rates are stable or declining. We steadily decreased duration 2 years ago as we were expecting rates to increase. Now that we believe we are nearing a peak in rates, we have started thinking about increasing duration again, partially by buying more fixed-for-life securities.
In such an uncertain environment, what role do preferred securities play in an investor's portfolio?
So the recent volatility has provided investors with more fixed income opportunities. Compared with other fixed income alternatives, preferreds are higher yielding, lower risk option. Additionally, rising rates have created an opportunity to buy preferreds at attractive prices. In fact, the preferred market is now trading at substantial discounts to par, levels not seen since the global financial crisis in 2009. Furthermore, preferreds have risen above their 10-year high in terms of yields. This is more appealing to investors who are searching for yield